Welcome to The Explainer. Today, we're basically putting on our financial hard hats. We are diving deep into the reforms in money market. We'll be acting as your policy architects today to explore India's massive structural leap from what used to be a really rigid, honestly somewhat chaotic financial setup to a genuinely world-class digital powerhouse.
Exactly. It's such a fascinating story of economic engineering. We're going to break down exactly how the government and the central bank cleared out the old crumbling foundation and built a modern skyscraper of liquidity.
So here's our blueprint for today. We'll start with an introduction to modernization. Second, the deregulation of interest rates. Third, new specialized financial instruments. Fourth, institutional innovations. And finally, the technological leap.
All right, let's dive right into part one. Introduction to modernization, clearing the foundation.
Okay, to really appreciate the absolute masterpiece of our current setup, you've got to understand the incredibly shaky foundation we were dealing with back in the late 1980s and 90s. The market was so volatile and it desperately needed a total overhaul. The Indian money market had this dichotomous dual structure, meaning you had an organized sector awkwardly trying to function right alongside an unorganized sector of indigenous bankers and local moneylenders.
Yeah, it was totally disjointed. That dual structure led to a severe lack of transparency and wild seasonal fluctuations. Like during peak seasons from October to June, demand for agricultural and business finance would just spike, resulting in massive, severe shortages of funds. It was literally like trying to drive a modern, high-speed train on broken, unaligned tracks. But the new vision? It called for a system that was uniform, stable, driven by actual market forces, and fully technologically upgraded to act as the backbone for a growing economy.
So, who was the master architect pulling this grand new vision together? That would be the Reserve Bank of India, or the RBI. As the apex of the monetary and banking structure, the RBI didn't just make minor tweaks. Alongside the government, they really spearheaded this massive structural overhaul to stabilize the market. They act as the supreme banking authority, and they knew that for India to actually scale and grow, the short-term money market had to be completely reorganized from the ground up. Moving on to part two, deregulation of interest rates, letting the market breathe.
This was a monumental shift. We're talking about interest rates finally being determined by dynamic market forces rather than rigid government-mandated ceilings. In the old days, those ceilings totally stifled movement, creating this weird lack of uniformity in rates across different financial entities. By removing those caps, wow, the market could finally respond in real time to actual supply and demand. It was quite literally letting the market breathe and find its own natural equilibrium.
Which brings us to part three, new specialized financial instruments, expanding investor choice.
Let's get into the fun stuff, the new tools. First up, Treasury bills, or T-bills. These are short-term instruments issued by the RBI on behalf of the government to handle temporary liquidity shortfalls. They became this incredible, highly flexible government-backed tool. By introducing them with varying maturity periods, the government could safely and efficiently manage its short-term cash flow needs without disrupting the whole system.
Next on the tool belt, we have commercial papers, or CPs. Now, these are unsecured, negotiable promissory notes that are transferable by endorsement and delivery, and they come with a fixed maturity period. This provided a brilliant new avenue for corporate liquidity. Suddenly, highly rated companies didn't have to wait around for traditional, slow bank loans. They could raise short-term funds directly from the open market.
And rounding out our new toolkit, we have certificates of deposit, or CDs. These are also unsecured, negotiable instruments in bearer form, but they're issued by commercial banks and development finance institutions. This basically gave those financial institutions a new way to mop up extra funds from the market to balance their own books. So together, T-bills, CPs, and CDs created this incredibly vibrant, multi-layered portfolio for investors to work with.
Up next is part four, institutional innovations, building the market makers. So, the year 1988. This was a huge turning point in India's financial history. Based on the expert recommendations of the Vogel Committee, 1988 marked the launch of a brand new institution designed specifically to anchor this newly flexible market.
Right, and that institution was the Discount and Finance House of India, the DFHI. It was built with one primary job, to act as an active market maker and inject liquidity into short-term assets. Jointly owned by the RBI, public sector banks, and financial institutions, you can kind of think of the DFHI as the steel beams of the new system. It worked entirely behind the scenes, constantly buying and selling these new short-term instruments to make sure assets flowed smoothly and the financial plumbing never, ever clogged up. But the architectural upgrades didn't stop there. First, we saw the introduction of money market mutual funds, or MMMFs. And this is absolutely crucial because it finally allowed everyday, regular citizens to safely get in on the action of these massive money markets, which was a huge win for financial inclusion. Second, the Liquidity Adjustment Facility, or LAF, was implemented using repos and reverse repos. If you're wondering what those are, they're essentially short-term lending and borrowing agreements. They handed the RBI a highly precise daily instrument to perfectly manage the money supply and maintain economic stability.
And that brings us to the final piece of the puzzle, Part 5, the technological leap, wiring the skyscraper.
Look, you can have the smartest rules, the most flexible financial tools, and rock-solid institutions, but if your communication still relies on paper, stamps, and physical couriers, your market is stuck in the dark ages. India totally rewired the system for the modern era. First, the electronic dealing system completely wiped out that lack of transparency we talked about earlier. Then came the massive rollout of the National Electronic Fund Transfer, or NEFT. And finally, the absolute game changer, the implementation of real-time gross settlement, RTGS. These mechanisms brought unbelievable speed, ironclad security, and split-second transaction clearing to India. What used to take days of shuffling paper around now happens securely in literal seconds. It really is a masterclass in economic engineering. We took a fragmented, highly seasonal, paper-based market and forged it into a fluid digital powerhouse. Which leaves us with a pretty provocative question for you to chew on. What will the next era of financial modernization look like for you?
Honestly, it's such a fascinating thought to end on. When you look at the sheer scale of these reforms, from tearing down interest rate ceilings to rolling out lightning-fast RTGS, it's just incredible to witness the careful architecture of our economy. We hope this explainer gave you a really clear blueprint of how it all works. Thanks so much for joining us. Keep learning, keep building, and we'll catch you next time.